when we are doing this, is that this is the IFRS 5, very clearly one of the important standards. Okay, one of the important standards with respect from the examination point of view. Is that what is the IFRS? That consists of two things. One thing is we are talking in terms of non-current assets held for sale, and we are talking about the discontinued operation. The rule says that, very focused, the rule says that IFRS 5 says that a discontinued operation is a component of entity that has been sold. See, you have the branches, you are doing the business, okay, you will have your own business, and when you have your own business, you will have different branches, okay. One of the branches you will sell, is that you will discontinue that, you will stop, and you will want to sell. If we want to sell that, this is a discontinued operation. How it has to be treated? It is that which is classified, and you will say that it is held for sale. Is that it is held for sale. What is the rule? It is a separate line of business, either in terms of operations or in terms of location. It is a separate location will be there. Okay, a separate location will be there. These are the conditions. It is a part of the plan to dispose of a separate line of business, or it is some different business will be there. Either it will be in terms of operations, in terms of location, or it is a separate different type of business. You will have the sales, okay, you will have the service, okay, you will have the service, you have the spares. Is it right? You have the spares. I'm talking about the cars, okay? You have the used cars, okay? You have the used cars, okay? You have the rented cars, okay? You have the rented cars. It means it is a separate line of business. A subsidiary acquired solely for the purpose of resale. Is that if we are purchasing any subsidiary, what is the intention? It is only the intention is to resell that business. If that is the case, it is going to be identified as a held for sale. What is the concept? We have to mention these rules in our answer. A operation is held for sale if the carrying amount will not be recovered. What is the carrying amount? Assume carrying amount is cost minus accumulated depreciation. Our carrying amount is going to be 10,000. We are not recovering the carrying amount. Is it will not recovered principally by continuously using. Means we will recover lesser than amount. To be classified as a held for sale, that the reporting that it must meet the following criteria. It must meet the following criteria. All the 6 points. All the 6 points it has to meet if we are going to classify as a sale. Is that you are selling your car, okay? You are selling your car. You are selling your villa, okay? You are selling your machinery, okay? You are selling your machinery. You will put it as a sale, okay? You will put it as a sale. When you are putting at the sale, what are the conditions you have to satisfy? What is the conditions? The operation is available for sale immediately in its current condition. When you put a sale for your car, the moment you put that label on the car, it is going to be sold in the current condition. The sale is highly probable, is that, and it will be completed within 1 year. Is that the sale is highly means the sale will happen and it will be completed in 1. You are committed to the sale, okay? You are committed the sale, and the operation is you are marketing it very actively, okay? Intention is very actively you are marketing to sell, and the operation is being offered for sale at a reasonable price. Is that means you are not overstating nor understating, nor overstated, nor understated. Is it to the current fair value? It is unlikely that the plan will change or withdraw. It must satisfy all conditions. even it is not satisfy any of the condition, it is not held for sale. In the examination, in the question, they will have to mention, they will give some condition. Even if all conditions are satisfied, then it is held for sale. If it is not, even one condition is not satisfied, it is not held for sale. Again, I am repeating, memorize these points. Away, it should be sold in the current condition, it be sold within 1 year, you are committed for the sale, you have to market it actively, and it should be a reasonable price, and it should not be withdrawn. Are you clear about this?
Yes, doctor.
Okay. Now, very important point. It's not difficult to understand. Okay, there is no difficulty is there. Only thing, by practice you will get it on your fingertips. IFRS require information about discontinued operation to be presented. How we have to present the discontinued operation? Any discontinued, it has to be presented as a single amount, should be presented. Only one value has to be presented in the statement of profit and loss account or other comprehensive income. It has to be shown as just you have to mention discontinued operation, that's all. You are not going to submit in detail. The total of the post-tax profit or loss. What is the total of the post-tax profit or loss from the discontinued operation? Any post-tax gain or loss on the measurement of the fair value less cost to sell. Is that we have to show it as the one line statement. See, I am telling you from very clearly from examination point of view. If there is a what they will ask, because it is a discontinued operation, it has to be shown as a single amount on the in the statement of profit and loss account and other comprehensive income. This much you have to write as per IFRS 5. Conditions will be there. The 6 conditions should be satisfied, and it should be in a single amount. Is that? That's all. This is all for our understanding. An analysis of single amount described should be provided on the. We have to, whatever we are going to write it in our explanation. Yes.
If one of the conditions is not satisfied, then
it is not. It is not. It is not. It is not. That is the reason. What they say, it must. They say it must meet the following criteria. When they say it must meet, it must meet all the criteria. All the criteria, not one. 1, 2, 3, 4, 5, 6. Simple. I'm telling you now, somebody will put villa on sale. When you say villa on sale, what will you will walk in. You will buy in the current condition. It is going to be sold within 1 year. We are committed. Once you are putting they have put the sale, they will not say we will sell it after 1 year. No, immediately it is available. Their commitment for sale. We are marketing the product. We are having a reasonable price, and most importantly, we will not change our decision. Is it okay?
Yes, doctor.
Okay? No. That's all. These are all our adjustments. If the decision to sell an operation is taken after the year end, okay? Before the year end or after the year end, but before the accounts are approved. And then if it taken the decision after the year end, it is a non-adjusting event. If it is done before the year end, it is an adjusting event. Okay, that's fine. Okay, after the reporting date. And if the decision is taken after the year end, then you have to disclose it in the notes to the accounts. Then the operation do not qualify because you have taken the decision after the year end. It will not qualify as a discontinued operation at the reporting date. We are going to show it in the next year, not in the current year. In the comparative figure, the operations are also shown as a discontinued operation. Is that in the comparative means we will show what is the happen in the current year and what is happening in the last year. Is it right? This is what we are going to work it out. Are you clear about this?
Sorry, doctor, can you repeat it again?
Means, see, what will happen when we have, see, in simple words, whether you have taken that decision before the year end or after the year end. If it is after the year end, it is a non-adjusting event. If it is not adjusting event, you have to disclose in the notes to the accounts. Is that if it is we have taken that decision, is it right? See that is it. You are talking about the reporting rate, is it right? This is your reporting date. Is it? This is your reporting date. Reporting date is going to be the 31st December. Now decision has been taken when we have to decision has been taken now. Is that decision is taken on 15th of January. 15th of January. Before it has been approved. When your accounts have been approved, your accounts have been approved in 28th February. The decision is taken on 15th. Then what will happen? It is a non-adjusting event. If it is done before, is it done before? Is that then it is a adjusting event. Is that if it is an adjusting, you have to adjust in the financial statement. If it is a non-adjusting event, is it right? If that non-adjusting event, you have to mention notes in the accounts. If it is an adjusting event, you have to mention in the financial statements.
Clear, doctor.
Okay, that's as simple as that. Okay, you have to adjust in the financial statement. See the thing. What they have mentioned, see, this is the statement of profit and loss. Is that they have shown it, they have shown it very clearly. We have to show it as a discontinued operations. Okay, loss from the discontinued operation, we will show it separately in a one-line statement. Is it? It is a one-line statement. We will not mix it up. This is with respect to continuing operation. This is with respect to discontinued operation. In the examination, they will not ask, but you have to write that the amount, it is a single amount, this is a single amount. This is a single amount we are showing as a separate line in the statement of profit and loss account. Loss or gain from the discontinued operation. Analysis of this loss will be given in the disclosure notes. Is it okay?
Yes, doctor. But this type of calculation is required in the exam, right?
No, this is not required. They will test you the conditions. Okay, they will test you the condition. That is the reason. They will test you. See, I am very focused here. They will test. When the moment I am putting a star mark, they will condition. We have to conclude. They will give you a scenario, and based on the scenario, we have to mention whether it is a continued operation or it is a discontinued operation. Is it okay?
Yes, doctor.
Fine. This fine. You read this one. I will not going to take that much time. Is it right? As per the conceptual framework, what is the purpose? Why we are doing? But this information. See, when we are talking about the conceptual framework, this is the general information which will be there in the every chapter and which will be tested in examination for 4 marks. entire question paper, one question will be there on the conceptual framework. Is that what is the conceptual framework? We are providing the information to the current and potential investors. Just customize the sentences and you have to write. Is that why we are providing the information to so that the stakeholders will make the decisions for with respect to the economic resources to the entity. Is that to make the decisions, users need information that will help them to assess what is the future cash flows. It is a general paragraph which will be there in every chapter. One paragraph will be there related to conceptual framework. Easy marks to score. Why we are talking about the conceptual framework? We are providing the information which is going to be relevant and which is going to be faithful representation. This is the basic thing which we have so that they can make the decisions easy. Users will able to make better assessment for the future profits, which has been clearly informed about the operation that is going to be discontinued for the period. We will disclose the information to the users that this unit has been discontinued, this unit has been continuing, so that the users should know that yes, the company shareholders should know that which has been closed, which has been continued. That is the reason we provide the information so that they can take the decisions to the best of their knowledge. Okay, to the best of their knowledge. Now, you have this question. Okay, you have this question. Is that now? The portfolio group of, what is the question? Explain whether each of the subsidiaries meet the definition of discontinued operation as per IFRS 5. I want to know whether it is yes or whether it is no. Read and tell. Based on those 6 conditions. A portfolio group of companies has a financial year end 30th June. The financial statements were authorized 3 months later. The group is disposing of many of the subsidiaries, each of which is a separate line of business of geographical area. When the financial year is ending, the financial is ending on 30th June. Okay, the financial year is ending on 30th June 2004. Now, the first decision, a subsidiary was sold on 4th January. Whether it is discontinued operation or it is not a discontinued operation. Tell me yes or no. One by one. Are you here? What happened?
I don't know. Am I audible to you?
Yes.
Okay. So the first condition, you mean that whether it's an adjusting or not adjusting?
It is a
right?
discontinued operation or it is not a discontinued operation?
It's a discontinued.
It is a discontinued. Next. Why it is discontinued? It has been.
Because they are announcing before year end.
Yes, January 1st. Next. Second one.
Okay. Second one. No, nothing related to regulatory, I guess.
Management, see, they have made the announcement that the advanced negotiation to sell the subsidiary committed to sales. Switzerland or subsidiary Switzerland was ongoing, and that only they are expecting regulatory approval. The sale is expected to be completed within next 12 months.
So they are willing to sell, yes.
Is it right? Management is committed to sale. Is it right? Management is committed to sale, and the sale is expected to be completed within next 12 months. Then it is going to be called as a discontinued operation. This much understanding you should have. That is not more than this. Is it this much understanding you should have. Next, what is the point number 3?
No.
Because they are not agreed on the price. Is that they are not agreed by the price. They are not they find a suitable buyer. There is no suitable buyer. None of have been they have identified. Is that they have not identified any buyer and there is no agreement on the price. If there is no agreement on the price, then it is not a discontinued operation. What is the point number 4?
No.
On July 10th, 2004, okay, announcement was made after the year end. After the year was made and Croatia was for sale. It was sold on 10 September. It is not, in this year, it is not a discontinued operation. Are you clear about this?
So in this case, in number 4, they have to mention it in the notes to the...
Yes, they have to mention
right?
in the notes to the accounts.
Okay. Okay.
This much, see, whatever they are giving, you have to be very focused on the understanding what's happening. Is it right? I will give you very shortcuts and very to the point. Is it right? Now you understand what is IFRS 5? Is it okay? Is it fine?
Yes.
No. Again, we have to mention this. I am very with all that confidence. I am putting a star mark. We have to mention basis for preparation of financial statement. IAS 8. It will be repeated. It will be. We have to. What is the basis of preparation? What the IAS 8 says. IAS updates to IAS arising with respect to IFRS 15. Because we have introduced IFRS 15, there is some updates with respect to IAS 8. This is new. Is it that this is the new one which has been introduced. IAS 8 basis for preparation was updated as a result of IFRS 18. The title IAS 8 was updated with respect to what? Previously it is accounting. What is that? Accounting policies, changes in accounting estimates and errors to basis. Is that previously it was the policies, changes in accounting estimates and errors. Okay, now they have made, it is, see, the some of the content from, they have taken from IES 1. Is it right? Some of the content from IES 1 has been moved to IES 8. This is the new one. We are not going to use IES 1. We are going to use IES 8. Okay, previously we have to using IES 1. Instead of that, we have to use IES 8. Very clearly, I am stressing it more specifically. What the objective of the standard? They specify the basis for preparation of financial statement with respect to the general presentation and concept, with respect to the criteria of selecting, changing and disclosing accounting policies. When we are writing in the examination, we have to mention IAS 8 basis of preparation of financial statements. This much we have to mention, okay? This much is that wherever there is requirement. Accounting statement and any changes in the accounting policy, any changing in the accounting estimates and any corrections we are doing. Three things are there. The first one is the accounting policies. The second one is the accounting estimates. The third one is the correction of errors. If any of these things has been done, then we have to mention that we are doing these changes based on what? Based on IES 8, basis of preparation of financial statements. Nowhere we have to mention IES 1, 100%. Okay, instead of IES 1, we have to mention IES 8 as such. Is that as? What are the what we are doing in the IES 8? What we are making the presentations? Is that in the IES 8 we will talk fair presentation? Is that fair presentation? Compliance with the IFRS accounting standards. We are talking about, we are mentioning whether it is a going concern or not, and we are using it on the accrual basis of accounting. Any matters, any one small thing they will ask, that's all. They will ask what is the going concern. If they mention about the going concern, we have to say that as per the IES 8 basis for preparation of financial statement, this is the treatment we are giving. Okay, this is the treatment we are giving. Now they have mentioned, is that they have mentioned a brief explanation about this 1, 2, 3, 4. Okay, what is the one they say they are talking about? Fair presentation. Is that what is the conceptual framework? Conceptual framework says that it is a faithful representation. Relevant, reliable and faithful representation. Is it clear to you?
Yes, doctor.
Okay, now when we do the things, okay, when we do the things, what is a IS? See, simple concepts, okay, simple, it will be repeated. IS, we are talking about the basis for presentation. It is a fair presentation with respect to the position, with respect to the performance, and with respect to the cash flows. Cash flows consist of with respect to the prospects. And it is it should comply with the IFRS accounting standards. Okay, it should comply with the IFRS standard. It should show a faithful representation. We have to select the definitions and recognition criteria. Whichever standards we are following, we have to follow the definition of the standard and the criteria of the standard as per the conceptual framework. When we are saying that we are following the standard, it means we are following as per the accordance with IES 8. When we are presenting the information, in the financial statement, what we are doing, it is going to be relevant, it is going to be reliable, it is comparable, and it is understandable. It is nothing but the qualitative characteristics. It is a qualitative. And apart from that, you will provide additional disclosures. If we need any other disclosures as per the IFRS standards, provide additional disclosures if the requirements of IFRS standards are insufficient. Means you should not have you should make it a basic understanding. We should not give a incomplete information. So that if you provide the additional information, It will enable the users to understand the impact of transaction with respect to the financial position and performance. Are you clear about this?
Yes, doctor.
Is that simple things, is it right? Now, entities should see what is the compliance. We have to compliance as simple as that. As per I will, entities should make an explicit and unreserved statement that the financial statement we have to mention that we are for every company should say that they are following the IFRS standards as such. Is that we have done with respect to the going concern? Is that with respect to the going? Point number 3. What is the going concern? Going concern means it is going to be there for the next 12 months. Okay, in other words, it is assumed that the entity will not enter any liquidation or it will not cease or it will not to trade. That is the reason when we are preparing the financial statements, we have to mention that we are presenting fairly, we are following the IFRS standards, it is a going concern concept and it is a accrual basis. As simple as that. Okay, ISRS state that management should assess whether the going concern assumption is appropriate. That is the reason. If you are not presenting as a going concern, then it is going to be a discontinued operation. Is that what is the same concept what we have learned in the auditing? It is going to be within the next 12 months we are going to run it. Is that now what are the conditions that it is not a going concern? Is that what are the conditions? The rules are same. We are not changing. It is a revision for you. We have a shortage, lack of cash and cash equivalents. Your liabilities are more. Your overdrafts are increasing, and in the form of short borrowings, major debt repayments are there with the next 12 months. There is a number of debt payables has been increasing. Your debt is increasing, level of gearing. You will have the negative cash flows. With respect to what? Negative as well, particularly in relation to operating activities. There is a disclosure of provisions related to the material legal claims. Your legal claims are increasing and there is a large impairment losses. If any of these conditions are there, it is going to be identified as a going concern issue. Are you clear about this?
Yes, doctor.
Okay, just read this one. When I am saying read, it means you should get the language of writing.
Doctor, if the company is willing to apply a breakup basis, it means that they are liquidating or ceasing to trade, right?
If the going concern, yes, it is not followed, the basis of accounting used is, it is a breakup basis. The reasons for not applying for going concern should be we have to mention why it is not a going concern.
Okay.
Okay, accrual basis. We are doing accrual basis means the transactions are even recognized. We may pay after some time, but it happened during the particular year. Is it not necessarily when cash is received or not? Is it? We are talking, what we are doing, we are talking about the sales. So it is an accrual basis. Outstanding. Is it right? It is an accrual basis. We will prepare our accounts based on the accrual basis. Okay, now. Are you clear about this?
Yes, doctor.
Now, IS 8, see, very is important, okay? IS 8 content unaffected by the publisher. This is not affected. These are other things has been changed. IS 8 content unaffected. Accounting policy. What is the accounting policy and what is the accounting estimate? Difference between these two is very, very important. Accounting policies are the principles and rules applied entity which specify how transactions are reflected in the financial statements. Is it right? How transactions are reflected in the finance. How the what is the accounting policy when an IFRS standard exists? Respect of the transaction, the accounting policy is determined by that standard. As per the standard say historical cost. Standard will say fair value. Standard will say the replacement cost. Whatever the standard will say, we are following the standard. If we are following the standard, then it is a policy. Some IFRS standards are offer they will choice in the accounting policy. Depreciation is a depreciation. Depreciation is what straight line method or return down value method. There is a you have the choice. The policies should selected should provide the most useful information to the financial statements. Okay, you have the choice whether you want to have a return down value, you have a with respect to the straight line method. Then automatically your judgment will matter. It is your policy. Where there is no standard is applicable, when no applicable standard or interpretation, management must use its own judgment to develop an accounting policy. Is that you should have your own judgment, okay, that I am following this. Now, some people will follow, see, most of the time, if you take into consideration buildings, if you take into consideration plant and machinery, okay, if you take into consideration plant and machinery, see there is a policy there is estimates is there. If they say we are saying that most of the time we will have straight line method, most of the time we will have the return down value. This is the policy. Okay, this is what is the estimate, whatever the amount we are going to say that it is going to be 10%, it is going to be 15%. Okay, that is the what it says is that if you are having your own policy, fine, nobody will question you, but you have to justify the thing. The accounting policy must result in the information which should be relevant and which should be reliable. Is that they should be relevant and should be you have that option, is it right? Every manager will have the option. Is it? So we have when we are doing that thing, you have to refer to the standards with respect to the similar or related issues, and you have to follow the conceptual framework. Conceptual framework means you have to disclose the information to the users. It should be relevant and it should be faithfully represented, and users can take the decisions based on the information provided to estimate the future cash flows. It is a summary of the conceptual framework. Is it? It is the summary of the conceptual framework. Is it right? Are you clear about this?
Yes, doctor.
Read this one. Preparers of financials should follow the requirements of IS preparation when selecting or changing accounting policy, changing estimating techniques, and correct. There are three things are there. We are talking about the changing of accounting policies, changing of estimates, and correcting the errors. Discuss the role of the judgment when selecting an entity. When you are selecting the entity policies, I will give you a brief parts. Okay, we can cover at a later stage in detail. When we are doing the things, what we have to do, there is a rule that when we are talking about the entity should follow. Okay, the entity should follow IES 8. Okay, basis for preparation. Okay, basis for preparation of financial statements. Is it basis for preparation of it? When you are talking about the basis of preparation of financial statement, we have to follow what? We have to follow IFRS. Okay, we have to follow with IF. You have to give IFRS reference. Is that with respect to the criteria? Is that we have to see criteria. Thus, this is the first one. Okay, this is the first one. Anything is there with respect to the accounting policies? When you are talking about the accounting policies, okay, when you are talking about the accounting policies should be consistent. We should not change accounting policies every year. Okay, we should not change accounting policies every year. Is that there should be consistency, okay, from year to year. It should be consistent on year to year basis. If any changes is there, okay, if any changes is there, okay, any changes is that you have to provide what? You have to provide justification. Are you clear about this?
Yes, doctor.
Okay. Now, accounting is that if it is you have to provide justification. Is that fine? Now, any changes in accounting estimates, what we will do? Any changes, okay? Any changes in accounting estimates. Can we provide retrospectively or prospectively? Can be done, okay? Can be done, okay?
What do you mean, doctor?
Prospectively. Prospectively means we have to do any estimates from the future, coming year. Okay, we cannot go to the back years. Okay, we cannot say that I will go and change the estimates with respect to the last year. Okay, if you are making any changes in the estimates, you have to make the estimates from the coming year onwards, prospectively. Retrospectively means backwards. Okay, retrospectively means backwards. Is it right? We should not make any changes from the backwards. If you want to make any changes, you make changes from the next year onwards. You have to tell them in advance, you have to make it next year onwards. Is that? Now, even in terms of errors, is that even in terms of errors, what we have to do, we have to make it, is that it should be have a faithful presentation. Is that faithful presentation? If the errors are there, it is right, if the errors are there, can we make errors from the previous year onwards? Is it possible?
No.
Is it? It is possible. You have to correct it. You have to correct it from the current year, and you have to make it. You have to, if any errors are there, you have to make the errors with respect to the current year. Okay, we have to expect in the current. We have to change it. Is it? In some cases, we can change the errors from retrospectively, but that is the most challenging situation. Is that most challenging situation? Means we have to mention when we are making any changes, we have to make our judgment. What are the reasons? Is that what are the reasons why you are making the changes? Now they will mention, is that in our question they will mention that there is a change in the policy, there is a change in the estimates. Is that what we are doing when we are talking about the things? Have to make it very specifically that the accounting policy should be consistent. We have to make sure that preparing the financial statement based on the IFRS criteria. We have to make it very clear that any changes in the estimates should be done prospectively but not retrospectively. These are the keywords. Is it right? These are the keywords.
I think in conclusion, accounting policy should be consistent.
Yes.
Accounting estimate should be made prospectively.
Yes.
And errors can be done retrospectively.
Retrospectively.
Okay, done.
Okay. See, what is the changes in accounting policy? Entities should only change accounting policies is required by the standards. You cannot change the policies if there is required in the standards, if the change results is more reliable and relevant information. Is that we cannot change the policy as per our wish and will. If it is needed, if it is reliable, if it is relevant, then only we have to change. New accounting standards normally include transitional arrangement, how it should be deal with changes in the policy. That is the reason. Now why they are saying this? Because they are saying that, see the thing. Now they have changed from IAS 1 to they have changed to how much? They have made updated to IAS 8. They mentioned that this will come into effect from 1/1/2027. They will mention that what are the changes. They'll say that from 1/1/27 they are going to implement IFRS 18. They are giving you time to realign, to readjust, is it, to make you well prepared. Enough time. They are given you 18 months since last year June. If I am right, since last year June, they are telling you that IFRS 18 will be implemented from 1st January 2027. So people will be prepared with respect to transitional arrangements. If there is no transitional arrangement, changes in our policy should be applied. If you are not doing any arrangement, then you can go back. But that is the remote chance. That is not going to be applied every time. Okay, if there is no arrangements is there, then you can do it retrospectively. But if you know well in advance, you have to means from in the year 2027 onwards, the accounting financial statement will be prepared as per the IFRS 18. Is it IFRS 18? Any adjustments in the opening balance will, with respect to the component of equity or any comparative figures are presented as we are following a new policy. Is there anything, any changes is there? We have to mention. That is the reason. 2027, what the ACCA people have done, they have started assessing. They have started assessing from, I think, from September 2025 exam onwards, that we are going to use this one. Okay, we are going to assess these standards from them. That is the reason whenever we are writing the question, we have to make it sure that it is going to be in reference to IFRS 18. Again, the same concept is there, conceptual framework. Read this one. You should be perfect in conceptual framework. Is that the moment I say conceptual framework, I will not go in, just I will give the reference and I will move ahead.
So I think in conclusion, they are meaning that we should compare what's happening in the previous year
Yes.
to the current year.
Yes. Any changes are there?
Okay.
We are. Is it now? See, very simple. See, it is nothing but see one single sentence message is you have to disclose in a very transparent way. That's all. Faithful representation. Everything will be solved. That disclosure is nothing but your explanation. Okay? Disclosure. Entity must produce a note of accounting policies. Is it an accounting policies are it will be likely to be material if related to that transaction. The entity change the accounting policy. What we have to do? The entity change the accounting policy during the report. If we are changing the policy, we have to disclose it. The entity choose accounting firms from one or more options as per the IFRS accounting standards are developed in the absence is that if you are choosing any accounting policy from one or more options or policy has been developed, if there is no standards, then you will have your own accounting policy. But that is the rarest of the rarest. That will happen in the very remote situations. Is it? They happen in the very remote situation. Nobody will do that. Everybody will follow the rules and regulations. The accounting policy relate to the area where significant judgments are required. Is that where the significant means it's not so easy. When you are stating the accounting policy, you have to give the reasons. You have to give the logical reasons why we are changing, what are the judgments, and most importantly, what are the assumptions we are making. Are you clear about this?
Yes, sir.
Okay, if it is going to be a complex issue, any unique issue, then we have to make the accounting. We have to mention the things. Okay, read this question example.
Can you give me 1 minute, doctor? 1 minute.
I will cover it in next chapter.
Please continue, doctor.
Okay. Same thing. Is there nothing is there? We have to make a disclosures where if we are doing anything, we have to make the disclosures. What are the key assumptions? What we have made based on that, we have to make the things very clear. Okay. What are the accounting estimates? The accounting estimates are estimates as a monetary amount. Is that the involved degree of uncertainty? We are making estimates. Where we are making the estimates, we are making estimates with respect to IES 37 provisions. Okay, we are making estimates with respect to IES 16. Okay, with respect to the depreciation. These are these are the basic things. Okay, we are talking about when we are making the estimates, we are making a provisions, and these are IS 37. Then we have to. It is an uncertainty. Accounting estimates are essentially part of preparation of financial statement. What we are doing. We are talking about the expected credit losses. Okay, we are talking about the expected credit losses for the financial asset. We are talking about the net realizable value of inventory in terms of IES 2. Okay, we are estimating. This is the net realizable. This may have the realizable value. We are talking in terms of depreciation of property, plant, and equipment. Is that a change in the accounting estimate? You see, a change in the estimate is not the same as accounting policy. Accounting policy is different. Accounting estimates are different. As per IS 8, changing accounting estimate must be recognized from future prospectively. Is that in the statement? Means any estimates are there, we have to change. If prospectively means we have to think from the next period onwards. By including in the statement of profit and loss account is for the current period and any future periods that are also affected. Is that means what will happen? Any changes is happening. Is that we have to take, we cannot go from the previous year. We have to go for the current period or any future periods. If there is any prior periods, any errors are there. Prior periods errors are misstatements and omissions. Is that of the prior year as a result of not using the reliable information that is available. What happens if there is any previous year errors? Okay, any previous year errors. What the IS 8 says that material prior period areas should be corrected retrospectively in the first statement set of financial statement or in the immediately in the first statement of financial statement authorized for issue after the discovery. Opening balance of equity and comparative should be adjusted to correct the error. If we have done any errors, previous year errors, you have to do with retrospectively, and it has to be done, it has to be adjusted immediately. Is that it has to be, is that the moment it is in the what they say, in the first statement of financial statement, that after the discovery, we should not delay it. Estimates should be done from future period onwards. Any errors should be corrected immediately in the current year. Okay, current year. Is that? This is what, are you clear about these two things? That is, you have to make. If there is a change in accounting estimate, must be recognized prospectively. Whereas the material error, period error should be corrected retrospectively. And it should be adjusted in the immediately after the discovery. These are the things you should know. And when you are mentioning this, you have to mention IS 8 particularly. Is it okay?
Clear, doctor.
Okay. Now there are some problems are there. Is that there are some, it is argued that the requirement of IS 8 to adjust prior period errors, is that everything will change. Okay, everything will change. Prior period errors retrospective may lead to earnings management. If you are changing any errors, definitely you are manipulating the earnings. Okay, by adjusting prior period errors through opening reserve, the impact is never shown with the current period of statement of profit and loss. See, if somebody, I cannot say, that is why it is very difficult. Okay, any errors has happened. If you are going retrospectively, means you are completely changing earnings management. Already we have decided. Already we have declared dividends. Already we have transferred. Again we have to redefine. Again you have to recalculate. Again you have to represent the financial statement. It is going to be more tedious job, and people will try to avoid this. In extreme of the extreme cases, people will make the adjustments or the corrections with respect to previous year errors. say whether it is yes or whether it is no.
No,
Why? Good.
because they are planning to depreciate the carrying value, which is not correct for the past years.
Yes.
They have to do it. It's an accounting estimate which should be done for the upcoming years.
Yes. Are you clear about this? This is it. This is the way you asked me how the question answers will be there. This is the way it will be there. And how much will be there? This is for the 4 marks. You asked me repeatedly. Okay? Then you have to mention with what we have to mention as per IAS 8, what the directors have done, what they should not do. We have to make a conclusion. If it is for 4 marks, how many? First you have to put the rule, what they have done and what is the correction. Okay, what is the correct way and what you have to do. You have to mention conclusion. You have to mention in first step. In the conclusion, we have to say it is no. This is the basic, understand point. This is the basic, this is what actually the question answers will be like this. How much is that? It is small one. Is that what is the carrying amount? At this date the carrying amount is 2 million. The machinery was depreciated using the production since the purchase. It would instead have a carrying amount of 1.5 million. The director wished to charge how much? 0.5 million annual to correct the discrepancy. There is error happened. Now can the character, if you are making the correction, if you are making the correction, the entire financial statements will change. We cannot make a revised estimate, and if you are making the revised estimate, it is nothing but we are doing what? We are doing earnings management. Make it a very clear, and I am telling you this. This is what you have to keep it in your mind, that in the question, whatever the scenario is given, always there will be some error will be made by the directors or the management. They have done something wrong. We have to make the corrections. If you come across, see, very simple, smart, you have to work very smartly. The moment you have to read the question, then you have to read the scenario. Then you say whether you have to write it is yes or no. Automatically you will say it's no, and according to that you have to develop your response. Is it okay for you?
Yes, doctor.
Okay. Now, there is another standard, is there, the interim financial statement. When we are preparing, what is the reason, what about in which situation we are preparing IAS 34. IAS 34 is prepared, which is when it is going to be, the period is shorter than a full financial year, less than 12 months. Is that less than this much? You should, this much concept you should be remember, as simple as that. If you are preparing a financial statement for less than 12 months, then it is going to be as per IAS 34 interior. May be required to prepare financial statements. We are not preparing as per the IFRS. We are preparing as per the local law or listing requirements. See, you have started your business. You have started on business on 14th of September. You have to prepare for on 31st of December. What you will do? Why you are preparing for? You will prepare the financial statements from 14 September till 31st December as per IES 34. And for the next year, for the first next 12 months, we are going to prepare as per the IFRS, or you are preparing as per IES 20, IES 8, okay, basis for preparation. If you are preparing for less than 12 months, the basis for preparation is as per IES 34. IES 34 does not require interim reports. They don't need any interior, but sets a principle that you have to follow with respect to the preparation, and specify what is the minimum information you have to present in your financial statements. What is the minimum? Is there minimum information? What you have to remember, I am telling you again and again. It is IS 34 into it is less than 12 months. Is that now? Why we are doing again, the conceptual framework will be there. It will haunt you every other time. It means when you are preparing the interim financial statement, same wording will be there. It should be more useful to the primary user groups. We are preparing the interim financial reports to provide up-to-date information with respect to performance, position, and the cash flows. Is that we are disclosing the information? Is that we are disclosing the information to the shareholders, okay, to the users? Is it right? So that they can know what's happening during the financial year. What are the components of interim financial report? It is a condensed. It's very specific. Condensed financial specific. Okay, we are not going into detail in the current financial year. Sometimes what will happen? It will be presented on a quarterly basis. It is a condensed financial performance for the current period, okay? And it not only it is a condensed statement with respect to, it is a condensed statement of financial position and a condensed statement of changes in equity, and a condensed, means short and sweet, of the cash statement of cash flows. That means we are very specific. Is that very specific? See, understand this. Okay, understand this. We are giving selected. We are not giving all the things. We are giving you selected explanatory